Okay, one sec. I'll make sure my all Zoom windows are okay. I can see all the messages. You guys can see the Word document. Discussion 317. Is that what you're seeing, or am I sharing something?
Yes, discussion 317. Yeah.
Okay, yeah, sorry, 317. Yeah. All right. Okay, so let's get started. Welcome everyone to our discussion number 317 for our every Saturday investor DIY investor meeting. Most of us are, I'm assuming that all of us are DIY investors and not really professional fund managers or financial advisors. I have had some times when we had some of those folks joining. They are also welcomed, but my content is mostly focused on how you manage your own money, and that's what I focus on. So thanks for those. We've been doing it for almost 6 years, and thank you for a lot of folks who've been there since day one. I really appreciate the time that you spend, every week. And I try to learn some new stuff from you guys, and hopefully to contribute in your learning, in your own investment journey. So the topic that I have for today is we'll continue the SaaS related valuation or SaaS metrics that we started last week. So last week we looked at operating metrics in SaaS based companies, right? What if you are an operator, or how do you measure the business side of SaaS, right? That's how that will let you know which businesses are well run for SaaS companies. Right. Today, we're going to talk about once you identify, okay, these are the great companies that I found out based on the metrics that I looked at, good run, well managed businesses. Now, is it a right time to buy or not? How do you do the valuation perspective? So today we're going to cover some of the industry standards, some of the metrics that analysts look at while evaluating SaaS companies. So that's one agenda. The other one is the hot topic of the market is SpaceX IPO, probably the biggest IPO in the history of IPOs. I think if I recollect right, Alibaba has so far has been the biggest one in terms of raising the amount of money from markets. I think Alibaba raised $25 billion, and SpaceX is rumored to raise close to $80 billion, maybe anything between, let's say, 75 to $100 billion. So this is going to be the biggest IPO. So we're gonna the S1 is not out in public so far. They have filed S1 confidentially, but I think that's good enough information for us to make a decision on what we want to do with SpaceX. Of course, this is the first meeting after the end of a month, so I will share my top 15 portfolio positions. I know last time someone asked about my position, and I said, hey, wait, I share top 15 at the end of every month. So we're going to do that and definitely look at some macro stuff and all that. Cool. Anything else you want to add it? So maybe we'll finish around 12:15, then we'll open up for a breakout rooms, and then it's all up to you how long you want to talk in breakout rooms. So that will be an agenda for our today's discussion. Anything else you want to add?
Hey, hello everyone. This is Piyush.
Hey, Piyush.
I maybe a topic for discussion: leaps on leveraged ETFs.
Okay. So, all right. So uh, I can talk about it right away.
Okay,
So
sounds
first
good.
of all, so leaps you should use. So I'm assuming everyone, or probably most of you, are aware of what the leaps are. We've covered in our previous sessions multiple times. Basically, that it's a good way to maybe do a stock substitution by buying deep in the money leaps, so that you get almost 80 to 90% of the movement of the stock, but you pay up, 15 to 20% of the cost of if you're buying the shares. Leaps are basically the options that are listed or that expires after 12 months. So basically long dated options. I think the name is long, I forgot, anticipation, whatever.
Y-
So now the question is, let's talk about the leverage ETFs. So leverage ETFs, as the name suggests, basically are not 1x, but 2x, 2.5x, 3x the moment. So they tend to mimic the multiple of the movements of the underlying. So if you got a 2x SPY leverage ETF, if SPY move 1 point higher, your leverage ETF will move 2 points higher. But if SPY goes 1 point lower, leverage ETF will go 2 points lower. Okay. These instruments, even if you talk to the people who sell these instruments, to the issuers, should not be inventoried. Means you should not be holding it for longer time. And in some of the previous sessions, I've run some of the simulations wherein it could happen that the example I gave of SPY, let's say you buy the leverage ETF today, and at the end of a year, SPY may still end up higher than where it is today, and you might lose money on leverage ETF. Because leverage ETF is not only depends where it ends, but also which path did the stock take to reach its end state, right? If the stock start to lose in the beginning, you might end up losing money even if the end SPY was actually ended up higher, because they do a daily they track on a daily to daily basis. So sometimes it could be just luck, you got lucky and you held leverage ETF for 2 months, you double your money or whatever, right? Even if I held 2x, you might just come up with 1.2, or you might come up with half of the money, even though the SPY could have stayed where it is, or even if the SPY could have gone higher, you could have still lost money in leverage ETFs. So me personally, I am not in favor of inventorying leveraged ETF. Means don't buy and hold for it, because when I run some random the trends, I like, come on, it's like luck. You can never be sure that if SPY ends up at the end of the year, if it ends up higher, I'm actually gonna make money leverage ETF. No, it depends on what path did it take. Then I heard a few podcasts wherein the issuers of the leverage ETF, and one of the big issuer is Direction, Direxion. So their head of sales, he was on a podcast, and the host asked him, that a lot of retail investors going crazy about it. He says, as an issuer, I'm happy that they're buying it, but no one should be buying it for more than a day or 2 days. It's mostly for risk management, not for inventory. Okay. Having said that, since you talked about Leap, the same stuff apply on Leap is a long dated. I am not in favor of doing anything which is longer duration on leverage ETFs, because you don't control the outcome. The outcome is controlled by the path that your stock took to reach to the end state. That's my answer on this one. Leverage ETF should be held very short duration to manage your risk, and should not be inventory. And even the issuers talk about it. So we try to educate people, but it's a free country. You're free to do what you want to do with your money. So
Yeah, thanks for your input and thoughts. So I do have Leaps open on Google and EWI. I do PMCC on those.
that's fine.
I bought it just before the war started, so obviously it's in downtrend right now. But yeah, this was one of the options which I was thinking about. Leaps on leverage, but I do tend to agree it's a bit volatile, and for longer period of time, holding leaps on leverage would not be a good idea.
Yeah.
But yeah, that clears up.
Okay. Holding leverage itself may not be good. I mean, you want to put it gamble with
Right.
small amount of money, great. But if you are thinking that the market so down and maybe in a year it will recover, sure, you could be right in your thesis, and you could still lose money on leverage ETF. That's the problem with the leverage ETFs. That's the problem I have. That even if your thesis is right, you could end up losing money because it didn't go straight up. It went down 50%, then went up 10%, down 20%. And you never can predict what the path is going to take. All right. So let's get into today's discussion then. At a macro level, I don't know what to do. Like you also say, right? The market is moving. There's a lot of tweets. We have a de-escalation, and then we got a Trump speech came on. Was it Friday evening, Thursday, whatever, right? In which we say, hey, we're gonna de-escalate it, and then the next day, we're putting more ground troops. Like Jose says, don't trade the news, trade the charts. So look at what's happening. And I just pulled up a chart from Bloomberg in terms of how much is the vehicles crossing through Strait of Hormuz. It's been negligible, right? Even though we have had so much of discussions around, okay, we're gonna get, both the teams have agreed to talk. So those are all talks. I don't know when the things will change. Could it, be over in a week? No idea. Right. And given the kind of administration we have, I don't even know how much we can believe that. Right. Is from if we have to believe the president, we have already won the war in like after 2 days. We've already won the war, right? But then why are we putting troops over there? Again, politics is different. I don't want to discuss politics here, but as an investor, yeah, I'll believe it when I see the numbers. So for now, I'm still not becoming overly bullish in my thesis. I still want to maintain the deltas that I have. It's not that I'm becoming like bearish as well, but just manage the deltas as I was doing earlier, right? But there could be some light at the end of a tunnel eventually, and like for me, at least we have seen many worse situations than where we are currently in. And it always feels like when you're during that time, it always feels like the things that can't go worse, right? Oh, this is the worst thing that we have been in. But markets have seen, worst scenarios than what we are dealing with currently. And so if we get into the worst case scenario wherein we get into a third world war and all that stuff, I touch wood, I hope it won't, then the portfolio will be the least of my worries. And if we don't get into that situation, either we will adjust to the new reality, like markets have adjusted to the new reality that this Ukraine Russia war is not going to finish. Maybe this will like continue for years, or if we get a peace, and then the market will go higher. So I think in a long-term basis, I'm still hopeful. Either we adjust or we fix the problem. In either case, markets will turn up higher. But in the meantime, depending on what's happening, in the short term, oil prices and all could go higher. We could have inflation, and we could get into a situation that we were in, like say 2022. Anytime we get a higher inflation, Fed start to increase interest rates, and if the pace is much faster than what the market anticipates, it takes time to adjust, right? But it will adjust. Will adjust. So as long as companies' earnings continue to grow, as long as the economy continue to expand, which we have seen over hundreds of years, it's only in one direction in a long-term basis. Why do I care? So depending on, if you ask me, am I bullish, bearish? Depending on, you could be, anyone in any of these situations, you could be bullish, bearish, or neutral, depending on what the time horizon is. Like I said, bull case scenario is we'll get a resolution to this. Base case is might take 3 or 4 weeks of closures. Your bear is maybe it will take 3 to 4 months of closure, so you're gonna be bearish on it. Or the tail risk could be depending on whatever how much time it takes to basically fix the supply chain. Now, recently, Iran had bombed some of the LNG supply chains in Qatar and oil fields, whatnot. So that may not, we may not be able to fix it in a month or two. I think some estimate says that it could actually take 3 to 5 years to fix it, right? So that could be a tail risk scenario. So depending on what's your time horizon, you can play the market based on what happens in the short term or a long term. Me personally, I'm not too worried about what it's gonna do in next month or next year, right? But if you look at the charts, like someone who want to trade charts, crude oil futures is pointing to lower prices, right? Trying to stabilize, so around maybe $70 end of December. So market is hopeful, or the traders are hopeful that we will get a resolution this year. Might take a few more months, right? But this may not be a long, long um, term event. We'll never know. We'll only get to know once we reach there. In every war that US has gotten involved, it always looks like, yeah, we're gonna go there, finish the job, and come out. Maybe a week, maybe a month, maybe a couple of months, and then we end up like spending years in those countries. Okay, right. So, but so far, the crude oil futures market does think that we'll get a resolution to this problem in a few months. Now, if you believe that, yeah, so then yeah, you could be a little bullish on it and start taking positions because the markets are in little more attractive valuation than where they were, right? So at the end of the day, don't mix politics and portfolio. Keep it separate. I am aligned on my long-term goal. But if some of the companies present an opportunity to bet at lower prices, yeah, so if I have a put spread, it comes in the money, maybe I'll buy it a little bit, right? I'm never in a favor of going all in at any prices. Uh, you can never time the bottom, you can never time the top. So be okay in terms of you buying it at maybe buy it on we call in at different times. Like DCAing is the best, but you don't want to DCA, maybe buying thirds or fourths, right? If you have a $10,000 that you want to invest, maybe put in $2,500 now, right? Again, so nothing different. I mean, especially not changing anything except the fact that I'm trying to utilize more of the capital because the VIX is higher. When the VIX is higher, the opportunity is more. So as compared to the previous time periods, like when the VIX was 15, you know, I've been selling more premium in this year because VIX has been like 25 plus, right? And believe me, seeing VIX as 25 plus is like a gift because I've traded in environment when VIX was 9. It was single digit VIX. I can't tell you how difficult it was in terms of trying to sell premium when the VIX is single digits, right? So this is like clear a caddy store where you have a VIX staying elevated above 20 for long term. Um, VIX futures have a strong support at 20, huge support on 16. Was the 20 is at resistance or support, Alfred? Forecast on LMT. I don't know. I mean, LM. All one thing which we do know is, I think in our new budget, in the new budget, our defense spending is, I guess, it's what $1.5 trillion is our defense budget. That's going to be the highest that we ever had. So from that perspective, it would be good for all of, I guess, all the defense sector, including LMT. I never looked at LMT as a company, so maybe we can look at LMT and see from a business perspective, how does LMT look like? You want to do that? Anything on LMT?
Yeah, I would love to.
Let me just, okay, let me just start the stuff and, okay, it's not yet started. Okay, so we'll get to LMT then. Sorry, I'm just trying to start website on my local. I don't know, I was working on something like yesterday night. Hopefully I've not broken it. I've yet to test it, but we'll see. If it comes up, then I will look at LMT. Otherwise we'll do it later. Oh, you support at 20 and Mega support at 16. All right, looking at a fear and greed index, yeah, we are still in extreme fear. So if you wanted to buy it, or if you've been sitting on the side and say, I want to put some capital to use, now may be a time to put capital to use, right? It's buy when there's a fear in the market. Like be fearful when others are greedy, and be greedy when others are fearful. And right now we're looking at there's a market is an extreme fear zone, and time to deploy the capital, like one third, one fourth, or whatever you're comfortable with. Uh, are you know, which is better time than earlier to deploy some new capital. And on an I mean, for me, this fear and greed index, in a very simplistic way, actually have worked out over long term. And I keep an eye on this and say, okay, if what the market participants are thinking about it, if they're getting too bullish, okay, you take a little backseat, or let the market participants do what they want to do, um, and you go in when the market participants are more fearful about it. So let me pull in Lockheed Martin, LMT. Okay, not a huge, obviously I can understand it's not a software company, so not a huge gross margins. They are basically buying back the shares, as well as they do also provide dividend. Pretty stable company, good cash flow company, um, and capex, etc. Not too bad. That's still okay. 20% of their operating cash flows is consumed by capex, which is decent fun. Yeah, I don't think it's very no, it's a decent business. Let me put it that way. The business is decent, and from a valuation perspective, it's not cheap. It's trading at almost forward valuation. Looking at 23 is little higher than where the markets generally trade, but given the fact that we're looking at high on a defense spending, right? It won't be the worst investment to do on this business. Now, I'm generally not in a huge fan of doing a investment in an individual company if I don't have a capacity to track them, like earnings or earnings. In that case, if I just want to take a exposure to defense sector, there are a couple of ETFs that you can use. ITA is one of them. I think they got Lockheed Martin and Boeing and whatnot. Um, then there could be a few more um, defense ETFs that you could look at. But I like Boeing, like $4 billion on cash. Debt to equity is high, but because they are a good cash flow generator, I don't think that is a problem for them. And yeah, or recently, I mean, it's a good free cash flow yield is also between on an average of 15 years, it's 5.82, right? So which is good enough.
Vivek, your screen sharing is paused.
Oops.
Screen sharing is paused.
Okay. Jeez. All right. So this is what I was talking about in terms of looking at. Oh, now the screen is working.
Yep. Yes.
Okay. Yeah. So this I'm looking at this decent buybacks, decent dividend, right? I understand operating margin, profit margin lower than what you'll see in software companies, but that's okay because this is not a software company. I look at a return on invested capital, a pretty decent one, and from a valuation perspective, um, not too high. I mean, it is 4p a little higher than where I would want it to be, but then it seems to be a decent business, right? So I'll be okay with that. Okay, what else? Uh, what if you want to look at an insider? I don't see too many buys. Mostly sells, and options maturities, 0 buys and 50 sales of stock so far. Yeah, I don't know. Is there anything specific around their segments? While this comes up. Come on. I don't know. I mean, if you looked into LMT before, probably then it'll be useful to look at in terms of how they're doing on individual segments. But I'm not on LMT, and no surprises that majority of their revenue is coming from US, 975. Yeah, 71%. Yeah, but from a quality of business perspective, it's a decent business, I would say, to own. But individual companies, you run the risk of what could happen to, you never know. CEO could be involved in some shady stuff. You never know. An individual company could get targeted of a cyber attack or state-sponsored cyber attacks and all that stuff. So unless you are willing to track it on a regular basis, might look at an ETF. Yeah, Shri, you had some question? Oh, okay. So, thoughts on Pfizer? SCSD has LMT and it is ETF. Yeah, but SCSD it has LMT because it's a high dividend yield company. So SCSD has a good solid companies that gives decent dividend, right? So from that perspective, yeah, if you have SCSD, sure. But I thought if you're interested on a defense specific, because with SCSD you'll get a lot of other stuff also. Home Depot is also part of SCSD. Some pharma companies are also part of SCHD, right? Because they are all decent cash flowing companies and they return that capital in dividends, right? So, but if you want only the defense exposure, might want to look at a defense specific ETF. Thoughts on Pfizer? Again, I don't own any individual Pfizer the company. I don't own it, but we could look at in terms of from Pfizer perspective. Now, what I don't like in Pfizer, and I think this is coming from the COVID side, is the deceleration in revenue growth, right? Over the last 10 years, the revenue growth has been like meager 2.5%. So it's not able to grow its revenue. And over the last 3 years, the revenue actually has been down on CAGR like minus 14%. So unless you are very close to in terms of understanding what do they have in their pipeline, they had a huge tailwind during COVID, and that might be skewing some of this data, like 14%, 15% negative because they had a huge run up in COVID. So I want to go back and look at pre-COVID stuff, right? I'm looking at as if this I call is a time machine. I transport myself back into end of 2021. No, so the COVID was in 2020, right? What am I saying? So end of 2019. So no COVID. Now, let's look at how it's been growing, right? Yeah, even on the revenue growth has been. No, I just don't like it then. Even if I'm sitting on 2019 and analyzing business when you never had a COVID tailwind, still, like last 5 years means for 2014 to 2019, the revenue has not been growing. So maybe, I don't know, maybe, again, I don't track this company, but this does tell me that maybe they don't have, at least last 10, 15 years, they didn't have any blockbuster drugs apart from what happened in COVID, right? So we did see a spike in COVID during COVID, but even prior to COVID, not much. So if we get into 2022, you should see some good revenue growth that came from COVID, right? So this is what came from the COVID one. But now the COVID has gone. the tailwind from the COVID has gone, I don't know how it's going to perform. And I don't have that great insights into the pharmaceutical industries and how to evaluate what the drugs they have in pipelines and the competition. So I personally would stay away. Now, given the fact that the stock price is, I don't have a stock price in here. That's something that I need to add. Is maybe beaten down. I don't know where is it trading? Say PFE. So the dividend yield, or let's say free cash flow yield. Let's go back to the current, right? If you look at it, it's a huge dividend yield, and that could be attractive. But it is just because the stock price is down, because it may be a business that is winding or collapse. Maybe collapsing is a too harsh a word, but business that is like finding it difficult, and hence the market is punishing the stock price, and which is then pushing up the dividend yield. Or maybe they actually could be returning good amount of a cash back to shareholders because they can't find growth opportunities. Right? I don't want to invest in a business wherein that the business says I'm in a capital return mode. You give the capital to me. Yeah, I'm not growing, so I will basically return the capital back to you in dividends. Right. So that's the case. I have a concern. Looking at the history, the growth is challenged. They generate good amount of a cash flow and they return all that back to investors in terms of dividend. That's my thought on Pfizer. Any thoughts on JP fund? JP is basically it's JP Morgan's income fund, right? Basically, you could do JP. I mean, it's one of the most successful ETFs launched in the recent times. Last I checked, it had what 70 billion, 40 billion AUM. 40 billion. Now it's 43 billion. So I personally don't buy any of these because I can generate the same stuff doing options myself. So why I would want to pay the expense ratio to JP is 35 basis points expense ratio. But if you're looking for an income, JP could be good. Right? It's basically generating you and giving you yield of around 8%. Now, what you need to be careful or is that I think all of these covered call ETF, they call them as a dividend yield, but some of the dividend could actually be a capital return, ROC, return of capital to you. These and the dividend and so-called dividend income from these funds have a different tax treatment than what the dividend you receive from actual businesses, right? So these may be unqualified from a tax treatment perspective. So you may want to look at those aspects of before you want to invest in any of these instruments. So in fact, today morning I was reading about, and maybe I thought I'll probably bring it for discussion. And if some of you have invested in it or looked at it, maybe we can have a discussion on that later. Is SBAR, which is there's an ETF issuer called Simply or Simplify, and they have called Simplify Barrier BAR Barrier ETF, and it's been a little weird structure. I took some time trying to understand it. Has anyone invested in SBAR? I have heard about SBAR. JEPQ, it's a brother of JP, brother sister of JP. JP invest in SPY and JEPQ is on QQQ. Anyone heard or bought SBAR? No? So at a very high level, I'm still trying to understand where the risk is, because there is never a free lunch. At a very high level, I'll tell you very high level. If you just Google for SBAR, it'll tell you basically that's a ETF which you're not gonna, so they got a barrier at 30%, means if the underlying that they're tracking doesn't fall, if it falls up to 30%, you are fully protected up to the period. Let's say you buy the SBAR, which is for 1 year, and 1 year later, the underlying falls 28%, right? your investment in SBAR is completely protected. But if it crosses that barrier, if it falls 31%, your investment is down 31%. And the underlying that they're tracking is a combination of SPX, Russell R, and NASDAQ. And they pick the worst of these three. So at the end of 1 year, because you took a 1 year duration of SBAR, if any one of these three is down 31%, your investment will be down 31%. But if any one of these three are down 29%, you're still okay. You don't lose any money. And then they use structured notes, etc., to build this. I'm still trying to understand where the risk lies. Of course, there's a counterparty risk because these are structured note, not OCC traded options. They don't use that. It's basically a contract swaps, etc. So you have a counterparty risk. But other than that, I'm trying to, what other risk is there? So maybe once I have a little more information, I can then come and talk about it in some meeting. And if some of you feel, again, don't want this to be turned as like a sponsor for SBAR, etc. But if you, I see some of these instruments I bring up for discussion, right? If you feel that this gels your investment thesis, that could be one way, right? Some people could say, come on, I don't think market is going to go down another 30%. We're already down 5% for the year, or let's say if you're down 10% for the year, if you don't think that is going to go down 30%, this could be a way to look at. And then I think the yield, again, they generate the yield by selling a combination of options, put options, and then they keep the cash in the treasury. The yield that they are able to get is around 11%, right? So for some of you, that could be an interesting one. Simplify barrier. Yeah, between the target yield between 11 to 13%, right? But there has to be something that I'm missing. So I've not yet figured out, right, where the risk, like it may not be apparent, but the risk could be somewhere else. Nitesh says, I don't understand momentum ETF. Yes, SPMO. I mean, this probably will have what momentum stocks, and those fellows are great chartists in our group, probably can tell, how to identify momentum using charts. And there are a lot of momentum traders. So basically it's a momentum ETF. When the things are going good, you gotta make money, and when things are going bad, you're gonna basically lose. You go with the flow. Sorry, maybe someone else can explain it better. We don't have a Jay here. He's a great with charts.
There is actually in financial academia for decades they have studied this concept of momentum, and so there's very well defined systematic way to evaluate momentum. But kind of colloquially, this reflected as what they call relative strength.
RSI.
And this guy they named what's his name? The Investors Business Daily guy. He basically popularized it as a relative strength, which is different from RSI.
Oh, okay. See, that tells you how much I know about the charts.
Well, because I've become so fascinated with this whole concept of momentum in the last couple of months, I picked up a book called Quantitative Momentum.
Okay.
And you guys can look it up, but it's something I'm going to read up on.
Yeah, Jyoti has a momentum, and sometimes I feel like Jyoti basically come on CNBC, but one of the segments will talk about, oh, we cannot take this out, or we have to put this in because this is in momentum. Yeah, so he has a momentum ETF. Right. So some investors or some of these Wall Street firms call our strategy is a momentum strategy, and then which is okay. But then you can't talk about that we basically invest in undiscovered gems. Come on, guys, both the things can't be true. If it is undiscovered, then there's no momentum behind it, right? So that's what I hated. You say we invest in the areas where others are not trading there, but we are momentum traders. How can both be true? Anyway, from fear and greed, I think we're still in extreme fear. So, well, if you have money on that side, maybe better time to deploy now. Same on the crypto side, we're still on the fear. sector performance, 4% down, right? And looking at some of our chat, oh guys, well, how do we trade this market? Market so volatile. Come on, we are not even 4% down. And we're behaving like there is a market is like crazy. I know
Last week, fear greed was at 10, was the perfect time to buy because it's already rallied up 10% since then.
it doesn't matter. I mean, again, I'm of opinion that you will never be able to buy at the bottom and you will never be able to sell at the top.
Right.
And that's why I don't sell and move to cash thinking, oh gosh, it's going to go down. I'll buy at the bottom. I'm just trying to fool myself. I'm trying to do this. I'm not a good timer. So I will just stay invested. So now, of course, when, the VIX last time went down, I increased my overall deltas. I was a little more comfortable in adding little more deltas at that point of a time. Okay, the markets are down. Maybe if my delta's gone up, hold them, right? Don't lower a delta if the market is down. But I don't know. Could have gone further down, right? So yeah, we are doing okay, guys. Market is overall is doing okay. If you are been in energy, that would have been great. You're up like energy sector as an overall sector is up 32%. Of course, you can find some great companies which are up 50%, etc. The worst performing sector has been the financials and consumer discretionary. I think Tesla is also dragging down consumer discretionary. Not that it wasn't a great position before, but Tesla story has been unraveling really not great way, right? So they are their worst. I don't know if it's worst quarter, but really very bad numbers around their monthly deliveries, way below analyst expectations. But who cares? I think Tesla stock was down 4 or 5% on that news, but that's it. Elon Musk probably will have some new other shiny object, which is in SpaceX. Let's look at the other side of Tesla. We got a robotaxis coming up. We got a Optimus and all that stuff. But yeah, financials are being dragged down by the concerns around private credits and what could happen. Financials haven't even on a year basis is down. It's even on a year basis it is down. Again, this goes to tell us no one knows anything. If you look at Bloomberg or look at many of these some of these fund managers' expectations in 2025, it was that the financial will be one of the best performing sector. But they had no idea about what's bringing in a private credit. We have no idea about what's brewing in. Right? So, and that is why you always maintain the portfolio in the sectors that you understand. Right? I don't think anyone knows what's going to happen in future. Everyone will guess it, and some are more intelligent guesses than others. But at the end of the day, those are guesses. Sometimes they'll come true, sometimes they won't. But there have been tailwinds on financials if we did not have this worry about all the AI disruption in basically all these some of these the blue owls and the blackstones of the world, Apollos, KKRs of the world have given so much loan to these software companies and have also sponsored are basically doing deals to build data centers and the data centers which will run the chips which will enable the AI that's going to disrupt those software companies. That's a concern that market has had. And of course, a lot of private credit side. I think this last week was the news. Again, one of the big private credit, they restricted their redemptions because they got, I think it was a Blue Owl. Someone please correct me and Google it. Maybe Blue Owl, one of the funds of Blue Owl, which is a tech specific fund, received huge redemption requests, right? And as per the prospectus, the fund, the issuers I mentioned that you can have only maximum 5% redemption request. I think they received like 5x more requests for redemption, and that is dragging. I mean, that is like another example. We have seen many of such issuers have been basically not allowing investors to withdraw their money. So that's been ailing financial sectors.
I have a question for you. So you discussed this software stock index, right? Basically software stocks. Now, looks like these credit funds are all were heavily invested or have lent to these software companies. So all their bonds are basically bonds to these Salesforce and so on, right? So if this credit funds deleverage so strongly, they dump their assets in the market. Do you think the equity side of it will be also affected? And so IGV and all will go down further?
Oh yes, if I think if we get into a situation wherein a lot of these private credit funds to meet the redemption request, if we have to dump their holdings, we will see some impact on the equity side also.
Yeah, that's what they have to, because there's no other. They are unable to raise new cash right
Yeah.
now.
So that is the right. We've been talking about a lot of the market has all been talking about blowing up of private credit, right? Guys, also look at the equity side. If the credit is so bad, right? And some of these private equity firms which are in pre-IPO companies, right? Their marks also have to move. They're not moving their marks yet, right? And I think it was Apollo's CEO in one or founder, whatever, the head of Apollo, and in one of the meetings in some conferences, he told the marks are everywhere. None of the marks are right, which is a big eye opener if you are investor in any of these like private credit funds, etc. This says none of the marks are correct. They're all over the places. Neither the credit side or the equity side, both are way off what they're where it should be. And it's coming from uh, the person who actually does this for a living. He was being honest. Uh, anyway, so yeah, so I think on the private equity side, because there is no liquid market for it, I think the valuations still have to come down. But I remember Blue All basically they restricted the redemption, so I don't know how much it is. Basically the question is whether the investors will have to suck it up, or whether the issuers will bend down and say, hey, as per our prospectus, we told you right from day one. It was not written in footnote on page 96. It was right up there on the first page, which says the maximum redemption allowed is only 5%. So suck it up. We're not going to give you your money back. If the issuers can do that, or the issuers could say, hey, I need to have a relationship with this pension fund or endowment for decades to come. Yeah, let me sell some stuff and meet the redemption request. But if you meet the redemption request, that will be not good for those who continue to hold the shares, because you'll be meeting the redemption request at the NAV, which is higher than what they're actually worth for, and basically then you're making fool of those who are still holding the stock. So a lot of stuff involved in this one. Again, I'm not too close, but if you're trying to buy any of these companies, BDCs, I mean, be careful. Be careful. That's all I'm saying. What from a stocks buys and sells? Nothing. It's only options. Nothing got assigned. Nothing got no puts got assigned. No calls got assigned. So or nothing deep in the money wherein I have closed the option trade and basically took a stock position. There's nothing much. It's only the premium selling for this week for me. What did you guys buy or sell? Let me understand. Again, this is even if I buy or sell, please don't go and buy what I buy or sell what I sell. Right? I just want to be transparent in terms of what I deals with.
Fortunately, I followed this principle of selling covered calls, and my Sienna and Micron got called away. This optical sector was so hot.
Yeah, so you haven't seen the video where I talk about how to generate income from the hot stocks. This is the lesson that a lot of my friends learned in 2021. So in 2024, last boot camp which I did, I changed and say, hey, for ETFs sector, do this. If you're dealing in stocks like Palantir or AAOI or Micron, which are hot stocks, do this strategy so that you're still in the game.
What is the summary of that strategy?
Summary of the strategy, do the spread or do partial. Like if you do a spread, you probably lose maybe 10% of the premium that would have given. Instead of getting $100 as a premium, you might have received $80 as a premium. But they'll keep you in the game if the stock goes up 100%, which some of these momentum stocks could. And what you are saying right now is a lot of my friends in 2021 came and poo-pooed this covered call. Ah, come on, I would have made a lot more money if I just held the stock, which is true in case of momentum stocks, right? But the momentum also cuts on the other way side. Then I said, come on, sacrifice a little bit of a premium, right? Or if you have a 200 shares, maybe do only one covered call, right? At the end of the day, there is no free lunch. All I'm trying to do is optimize based on what's your outlook is.
So which covered call, which spread would you sell to on a hot stock right now, like you mentioned?
I mean, I don't have any more. I have Palantir, but Palantir I'm okay to let it called away. So I'm not doing covered call on it. But let's say
AOI.
AOI. So let's put AOI, right? AOI.
Just as an example, or any
Yeah,
name.
just take an example. I mean, so
So let's
AOI.
sell a covered call and
All right,
then
let's go to the May expiration. The regular May expiration. All right. Wow, the bid. Whoa. Jesus, it is really look at the IV 150%. For a moment, I thought, is it like $1,000 stock? Then looking, no, it's $100 stock, and it's got
stock bounced 30% in 2 days,
and it's got an $18 premium. Now I understand. So let's say if you own the stock today, right? Let's say I pay $108, consider 110 for simplicity purposes, right? Maybe I could go and sell 150 call, and they don't have it anymore, or maybe 140 call, and right now there is are not listed, but if it would, then I would say 140 and then maybe buy 190, right? 190 you would maybe able to buy it for around $3 or something. 165 at 650, I'm looking maybe 192, $2.50. So you end up eventually, instead of getting $9 or $9.50 as a premium, you might get $7.50 as a premium, right? Which is still not bad. You're already giving yourself 30% upside room, and on top of it, you're getting 7% in a premium, $7.50, right? To keep you in the game if the stock goes to 200.
yeah, basically saying you're kind of like buying the stock at 190 and therefore keep staying in the game, I guess.
Exactly. Yeah. So you take a loss on your option trade, you lose $5,000 on an option trade, but dude, it's gone from 110 to 190. You eventually still made $4,000 plus on a long stock position, plus $700 that you got as a premium, and you're still in the game. If the stock goes to 250, you're still in the game. So figure out in terms of, hey, it's okay to lose a little bit of a premium if I want to stay in the game, especially these momentum stocks. You never know. Like, look at the people who maybe bought, let's say, GMEs of the world and had only the covered calls on it. I don't think a lot of retail investors were doing it. I think it's only after the GME a lot of retail investors got into it. But this is an example. And if you think this is a good company and you don't want to let these shares go out, because its future is good for it, then just do a spread. That would be my recommendation. Right? Or if you have 200 shares, just do one. So that is still your other $100 can still continue. Sorry, 100 shares can still continue to be in the game.
Thank you.
What else? P-Lab. Reddit at 145, Apple 254. P-Lab. I don't think we ever talked about P-Lab as a company. What is this company? So let me fetch some financial data for it. Which why not sell the call and the put for the same stock? Either you getting shares by assignment or if both assigned swap the lots. But if you're selling the both call and the put, then what if the share goes down? You need to basically be okay to buy the share, right? So I do on many of the stocks, both sides. I love to play on the both sides if I think I can buy the stock a little cheaper. But it depends. It depends on if you want to play on the both sides or not. Just don't make the mistake of getting sucked in by the amount of a premium that you are seeing. Right now, you might feel, oh my gosh, this has got a great stuff. I'll be okay to bet 80, like 20% down, and you're getting paid almost $9, which is almost, let's say, 11% of your cost. It will be 11% further cost basis reduction on it. Right now looks great because everyone is talking good things about it. But I have been in stocks wherein the stock was at $50 and you sold a put at $30, and now the stock is sitting at $2. That buy at the $30 doesn't look smart anymore. I'm not saying that is AOI, but I've seen many of these momentum stocks. They were just going in momentum. They may not have been great businesses. AOI may be great business because right now it's all transfer using optical technology instead of a copper wire is pushing up many of these shares up. But the question is, what happens if that tailwind goes out of it, and when that tailwind will go out? You do the study, and if you think it could be a great buy at 70 or 80, bringing your cost basis to $70, buy it. I mean, you can sell a put at 80 and play on the both sides.
Yeah, this is just a mania for it's a momentum trade.
It's a
Those
moment.
who want to take part of the momentum trade, go for this.
Like I have seen Neo.
It's unprofitable, unknown. I think the market names in this are Lumentum, which is Light, Lite, and Sienna. I know Sienna because I personally was working in Sienna back in year 2000.
So like I've seen Neo trading at $50 at some point of time. Right now it's sitting at $6. And I've been this stock for now what 6 years. I mean, for me it doesn't matter because my cost basis is less than zero. I've sold so much premium that I got all the money back. But imagine someone around whatever 2021, when it was whatever $50-$30 and you thought $20 is a good buy, and because that time the premium was higher, everyone was piling into some of these stocks, momentum stocks. That buy at $20 doesn't look smart anymore. That's the issue. All right, so let's continue on the portfolio side. As the end of March, this is my position on top 15. No change in overall constituents on who are on the leaderboard. But if you notice ACHD, in fact, during mid of the month, somewhere ACHD was my number 2 position. But now I think Melly just regained in last, I would say, week. The last week, Melly regained. The stock price was up a couple of $100, so it became number 1. Basically number 1 individual stock position in my portfolio. I'll give you 30 seconds to look at it, ask me any questions, then you wait for a question for after the next month end.
What is the reason for so much exposure to SCHD?
SCHD, I have seen when market zigs, SCHD zags. So it gives a little balance to the overall portfolio. So if a SPY goes high, SCHD doesn't perform. If a SPY is not doing good, SCHD perform. That's the only reason. Because underneath SCHD, it's got some good cash flow generating companies because this is focused on high dividend yield. I'm not doing it for dividend income perspective, but the fact that this becomes a proxy for me to own the companies where people would want to move when they feel little concern about markets or cautious about markets. That's the reason SCHD. It became my number 2 position because this year markets haven't been doing good, right? SCHD is up 10% for this year.
Actually, it says 15.7% this year on Yahoo Finance. I'm
That
shocked.
might be including dividend. Oh, yeah, I don't know. Did I? Yeah. So this calculation may not include dividend.
I mean, this
Yeah.
is much better than
Yeah. So in any case, it is because the rest of the market has not done well. But in 2023, 2024, ACSD was, or maybe, I don't know, one of these 3 years, when the rest of the SPY is up 20%, ACSD was up like 2%, 3%. I guess that's not counting dividends, right? So that's all. It is not by design that I pushed it to number 3. It just became number 3 because of it has performed and the other stocks has not performed this year. But I always want to have a short put on ACSD because for me, I just want to de-risk my portfolio a little bit. That's the reason. Any other questions? How much percent cash? Cash is right now 3.75%. This does not include my ICSH, which kind of where I park the cash. So, but maybe I can look at and see what, if I were to include ICSH, what would it be? Meanwhile, any other questions?
Why do you keep holding Apple? Apple is a defunct company.
Huh?
This is my opinion.
$200 billion in cash. You know, I that's something I can't ignore. Again, so if there's a concerns around AI, etc., people will go back to the companies that have got good balance sheets, right? In good times, people focus on P&L. In bad times, people focus on the balance sheets. Right? So Apple has got a great balance sheet, and I'm okay to hold it. If nothing else, they'll just buy back the shares. Right? They'll just buy back the shares. So that's the reason. But we have seen Apple also, doing showing some growth back in China. They're back in China.
Where? No. China.
Yeah, Paul. All right, maybe I'll mute you. Maybe something side conversation. Isn't SCSD and BRKB already overlap? May not be exactly. Right, BRKB, I don't think BRKB has huge holdings on, let's say, pharma. Right, if you look at SCSD, they got a couple of big pharma companies like Johnson & Johnson, I guess, AbbVie, etc. Let's pick up SCHD. But from a thesis perspective, yeah, both are same. In terms of when the market feels concerned, they'll go towards these companies which are cash flowing or the businesses like Berkshire, the business that Berkshire owns.
Right, that's where I was going with Vivek, because Berkshire has that value investing defensive
Correct.
investment thesis. SCHD also similar, right? Even though it's a income generation they call it, but it goes in similar way. When S&P goes down, they do well.
Yeah. So the reason why I'm on SHFD because I don't have any individual exposure to the pharma or any of these companies. Right. So if I look at these all the way till, let me see, which is the company that I actually own? I don't own any of these. I think the first one which I own is, no, I think Ford Motor also got called away. Maybe I'm trying to get rid of it, so it will be out. So good, I don't own any of these companies in my portfolio. So that gives me little diversification around what I already own. Like some of the companies, like I said, I'm not good at analyzing the pharma companies and all that, or the healthcare companies, these are all regulated, but I get exposure through SCSD. I've been in SCSD for many years and so far so good. Any other questions? Last call. Otherwise, then hold your questions after end of next month.
Vivek, that's really helpful because I have been contemplating to add a CHD for some time, but I never pulled the trigger. The reason is do I really want income? But I see the way you're basically adding a defensive component in your portfolio, and that's important too.
Correct. It's not for income. I don't. So if you ask me as an investor, I rather don't want my companies to pay dividend. I would rather have them, because dividend is a tax inefficient way of returning capital to shareholders. I would rather want them to buy the shares. But the fact that companies have a capability to pay dividend, that tells us something about how they're managing their business, and that's why I'm picking SCST. And I looked at many of such ETFs. Noble is another ETF, but SCSD basically I found the best of the lot with the least expense ratio. If you look at SCSD's expense ratio, and I'm talking, I probably did this like 7-8 years, 0.06 basis points. It's as equivalent to any some of these Vanguard ETFs, if not better. That's why I'm on SCSD.
Sorry, I missed that. Why is it better than Vanguard?
No, I'm saying from expense ratio perspective, it is 6
Oh.
basis points is better than some of the Vanguard ETFs. Right?
Does
So
that-
I looked at, I think when it maybe in 2017, 18, I was trying for get some like defensive stuff. I'd look at Noble. I looked at few other ETFs. I had a list of those ETFs. Eventually, after like month or 2 months looking at it, I finally decided on SCSD. And now since then, I've been just, adding SCSD position. Yeah, on the days of when the markets are all green, Gaga days, SCSD doesn't perform, but that's okay because I hold a lot of other QQQ and other, the call it momentum stocks or whatever, right? So I need to balance it out. For me, the biggest, I think the first objective of managing money is just survive. I just don't want to get taken out. And in any case, I don't care if market goes 40%, I have to just survive. Rest market will take care of me.
So I have something called CHY, which is like a bond fund which is focused more on high yield convertible bonds.
Is it
And
the California Muni?
no. This is like countrywide, but basically it yields constantly 11%. And so I'm just wondering, would there be an overlap? I think this one is making money from the bond side, and yours is a dividend equity type stuff.
Yeah, so
But
this is Calamos.
Yeah, Calamo CHY.
Convertible high.
So it religiously pays out 11 or 12% dividend. I mean, essentially income. And yeah, so the capital price, the price has just fluctuated around 11, 12 for ages.
Yeah, so it's if you're like a fixed income guy, sure. But SCSD also has a capital appreciation because it's actually owns the companies underneath it. Right? You got an equity in this company. So
Mhm.
I think two different kind of investments, I would say. One is fixed income. You don't have your max upside is whatever the bond coupon rate is. Right. All right, so let's continue then. No further questions. Again, why did you buy Facebook last week? Last week I shared the tweet, right, on my logic of buying Facebook, because Facebook was punished after they lost the lawsuit, and market was thinking that this is going to be the same fate, will meet the same fate as tobacco companies. I don't think that would be true. And the more important reason is I always been playing on both sides of Meta. My put spread was in the money, deep in the money, so I thought I'll buy it just to get my emotions out of it. That is why I love to put the trade the moment. Now, like I already have a trade for May for Meta, right? I'm done with April. Like already put a trade for May, so that if it goes further down, yeah, I'll buy it. It will be very difficult decision to make a decision to buy when the stock is down 20%, even though we all know inherently in our mind that that is the best time to buy, but your emotions get caught up in it. Oh my God, it could go further down. I don't know. There's a lot of stuff going. So I'll put myself in a situation that, okay, anyway, my put spread is in the money, so anyway, buy it. Otherwise, I'm going to lose money on an option trade anyway. So I might as well reduce my cost basically by buying some other shares. Some mental gymnastics. All right, let's jump into the SaaS valuation metrics. Then we'll talk about SpaceX IPO, and that'll be it for today. Okay, so the biggest one is discounted cash flow, right? This is our holy grail. Again, I'm talking purely from a fundamental investor's perspective. How do you value a business? Again, all investors over the decades have been focused on the terminal value of the business is the sum total of all the cash flows that it will generate over its lifetime, right? Discount that to the present value. That's the valuation of the business would be. So I'm not going to go into that. Doesn't apply specifically to SaaS, so I'm not going to get details into it. You can look for a DCF. It's a pretty common. All CFA guys will use DCF to find out what the valuation of the company is. What you see on your ticker is the price of the company. Right? That's not the value of the company. That's the price of the company. Price is what you pay. Value is what you get when you buy the company. Okay. So, and when I generally, I mean, I have done DCF for some companies, but DCF to do a good job with the DCF, you have to have a good sense of how to predict the future, right? Which is, dude, I don't have a crystal ball. So what I generally use, and it is not specific to SaaS, is I don't know what the business is going to grow 5 years, 10 years down the line, especially the companies that I get involved in, like tech companies. Dude, we don't even know what 5 years later look like. Nobody knew these LLMs and cloud will come like 5 years ago. So things get disrupted so soon that trying to predict in future is kind of pointless, especially on the tech sectors, right? I generally use something called a reverse DCF, which like, I don't know what's in future, but I can surely know what's market price, today price, what's the growth it is pricing in, right? Rather than trying to go to the DCF side, which is you find out what the how much is expected to grow and all that stuff, find out the cash flows, then discount it. I'll say market, you are pricing in $100 the stock. What's the implied cash flow growth that you're looking at? And if that cash flow growth seems to be way higher than companies ever did in the past, in its history, or in the competitor's history, or in industry, or across industry, it does tell me, that maybe is something difficult to achieve. Not impossible, not impossible, because we have companies who have done the things that never been done in the history. Will that give me a wrong signal for those companies? Sure, okay. I'm okay to live with it. So I actually do reverse DCF than doing a DCF. I've done DCF for fewer companies. I used Professor Damodaran's Ninja Excel, pulled in the data and put in the numbers, put in my assumptions, and any DCF is as good as your assumptions in it, right? And then I have done a DCF to find out what the present value is. But that was more of an intellectual exercise just to understand how the stuff works. But I mostly focus on reverse DCF. Right. Now let's talk about, especially on the SaaS, little different stuff, because many of the SaaS companies, when they start or they come to IPO, they have no earnings, there are no cash flows. Now, how do you even apply the reverse DCF or the DCF? That's where SaaS specific, there are few things that analysts would like to look at. If you're a purist, you will say, oh, this company doesn't generate any cash flows, or not expected to generate cash flow for the next 5 years, I'm not going to even touch it, right? Because I can't know what the value of the company is, because there is no cash generation. There's no cash generation involved in it. The business doesn't generate any cash, right? You can be purist, or you could say, hey, these are companies which are been investing every money that they have in a future growth, and then I still want to own these companies. If you're done purely DCF, you probably would have never owned Amazon or many of these tech companies, So when it comes to the SaaS or really this tech company, there are different valuation metrics that the street would like to use. So let's go through that one by one. First is multiples. Again, this is not a valuation metric. Multiples are always pricing metrics. And you will feel when some of the folks on CNBC come and say, okay, we value it at 23 multiples. But dude, you're not valuing it at 23 multiples. You're pricing it at 23 multiples and you're okay with it. It's a pricing one. So first is multiples of value or multiples of revenue. And you look at a enterprise value, which is basically market cap plus the debt that they have taken. Maybe a few years ago, I wouldn't have worried about debt because many of the tech companies generally didn't have a lot of a debt component. Right? They don't take debt. Most of them was equity. But given what we are seeing nowadays, you would have to worry about debt. Right? Because a lot of companies are raising funds through debt and then investing in businesses like build data center, whatnot. So either you can look at enterprise value and to revenue ratio, either for the current year or the year past, or look at the next 12 months. I would generally like to look at next 12 months because past is past. that's like I'm watching in a rear view mirror, right? That this has happened this year. I want to look at what's the projection for the next year and then look at what's the multiple is, right? Or do a free cash flow, but like I said, you can't use it for comparative purposes because many of these companies don't even have a free cash flow. But when the markets are in trouble, like we had in 2021, especially the tech sector, immediately all the VCs, immediately all the Wall Street analysts started looking at why you're not generating free cash flow. Right? When the markets, and that is why when the markets are in trouble, everyone wants to go to the companies which are generating cash flow, or they want their portfolio companies to start focusing on cash flow, right? So you could use either of these, but be careful that many companies may not have a free cash flow. So that's a multiple. Now, multiples could vary, right? You don't want to bucket everything together and say, okay, I think I'll be willing to pay 8 times my revenue multiple or 10 times revenue multiple. The other way you could look at is if it's a high growth company, I may be willing to pay higher multiple. Maybe bucketize it, categorize it, and say if it is a mid growth, then I want to, even if not in absolute terms, you would want to compare a mid growth company with another mid growth company and say, why would I pay 40 times sales for this growing at 20%, whereas another one is growing at 20%, is available at 20 times the revenue. It does tell you one of them is not being priced. It's been overpriced. And that overpricing could be for anything, right? It could be because there's a momentum in it. It could be because there's a short squeeze going on. It could be because it's a retail favorite and they're buying the long, out of the money options and the market makers are hedging it by buying the shares. It could be gamma squeeze going on. The current, but it will tell you comparatively, oh gosh, this seems to be pretty more expensive side, right? With the similar growth companies. So you look at multiples, but then you could bucketize it further because the companies, especially on the tech side, the growths are all over the place. There are companies that are growing at 60%. There are companies that are growing at, if you consider Apple as a tech company, growing at 4%, right? So that's different. That's one way to look at it, is a multiple and then categorize it as at a growth level to do a comparison between two companies. Multiple could be multiple of revenue, or if you generate free cash flow, multiple of free cash flow. I would rather focus more on the multiple of revenue. That's what Street want to focus on. Okay. Second thing is, how about basically adjust that metric and give me one number which basically neutralizes the growth component. This is a growth adjusted metric of enterprise value to revenue, adjusted for the amount of growth, right? So basically EV divided by net 12 months revenue divided by next 12 months growth. So that means a company that is trading at 20 times the next 12-month revenue, but if it is expected to grow at 100%, that number is 0.2x,
Picture.
0.2 multiple. Or I'll need to put folks on mute. Guys, if you don't have a question, just put yourself on mute. I'm getting some feedback. So expensive 20x multiple, because trading at 20x multiple, it might, if you just look at the multiple, it might look you more expensive as compared to the company that is trading at 10x multiple. Gosh, why should I pay? Again, just bringing this discussion into a number, right? But if you use this, then you realize that it's okay to pay 20x multiple because it's growing 100%. So the overall ratio come out to be 0.2, whereas the 10x multiple for a company that is just growing at 20%, this probably is even more expensive company. So the 10x, currently 10x revenue multiple is more expensive company than a 20x revenue multiple, considering the growth for next 20 months. So you basically neutralize or baseline from a growth perspective. Right? And you can use it for a comparison across different time periods, even for the same company. You could look at Apple was growing 10% per year, and that time the company was being valued at so much multiple. Now, what is less or higher? Then you could look at was the economic conditions different and whatnot. So, or you could compare it with the same different companies in the same time period, right? And in the same industry. Another, adjust your multiple with growth expectations because both go hand in hand. Other valuation metric, so there's a question, 20 by 10, why divided by 10 is growing at 100%? No, I think, so it's, sorry, it would be 100, right? That's why it is 0.2x. Typo. So the other company, which is generally at a very startup level, you'll see, or the company, not even a startup level, companies that just come IPO, is a focus on ARR. This is the metric that CEO or the CFO will come and talk about it, that my ARR is this, right? Now, the difference between the revenue and the ARR is revenue is bound to a time period, right? If I'm looking at a revenue, I'm looking at, okay, what's my 2025 revenue? That's my prior year revenue. Or what's my 2026 revenue, which is future revenue. And what ARR does it is a little more nimble. And that could cut on both sides, right? But it's a little more nimble. Rather than looking at my projections for the year, I will tell you how this month has done and you multiply it by 12. Maybe we figured out a better sales strategy. And from this month, and we're going to continue for the next 12 months. So I don't want to look at my last year revenue or the revenue projections or 10% what I get, because my business model is changing, or we've been introducing new product at a very high, very quick pace. Like Claude is introducing new stuff like every week. So when I'm trying to evaluate Claude, looking at a last 12 months is useless. I would rather look at an MRR and use that, saying, hey, all this, and say that may be a better representative of the eventual revenue or the growth of the business. So your ARR is what is called annual recurring revenue. That's basically based on your monthly recurring revenue multiplied by 12. Now, there are some cases in terms of what you consider recurring revenue. You take out the professional services cost out, the one-time revenue out, which is PS is one-time revenue. You only look at a recurring revenue because that gives the insight into, hey, this is going to continue. As long as the customer is there, they're going to pay up every month. That's why the market loves this subscription businesses. You get in and they get paid every month after month. Right? So you look at your MRR multiplied by 12. That becomes your ARR, and that's what most of the time you'll see CEOs, CFOs, or the investors talk about it, because especially in case of a higher growth company, in case of companies that are scaling their businesses, because month after month things could change. Third thing, which you'll see some CEOs talk about. Sorry, any questions so far on the multiple side before I move on to the other way to look at it? So you could say multiples of ARR, multiples of free cash flow, multiple of revenue, and then the growth adjusted multiples. Any questions on multiple based metrics? No? All right, let's move on to the next one, which is rule of 40. And if you've been in Valley or if you've been investing in, some of these high growth startup or not startup, we're talking only of public companies. So I wouldn't say startups, or I would say the young companies that are growing, they're still public. They're a public company in the market. You will see a lot of them talking about rule of 40. Right? Palantir CEO is famous for talking about rule of 40. Right? Hey, this is how we did against rule of 40. So what the rule of 40 is basically says your revenue growth. And now I've seen two definitions. If some of you are actually analysts, please correct me. But I've seen kind of a two definitions used by it. What I see that for little bit more companies that are actually start to generate, who start to focus on profitability, analysts will use revenue growth plus free cash flow margin, right, as a rule of 40. For the companies that are still in a hyper growth mode, revenue growth plus operating margin. My favored metric out of these two is revenue growth plus operating margin. Now, why this rule of 40 is? Hey, if I'm a growth company, my focus is all on revenue right now. And I'm okay to not make margins because I want to focus on growing the business right now. And once I got, like Amazon did this for years, right? So if you're not making margins or margins are negative, then how do Wall Street think, it's okay, negative, but how do you even evaluate you? They came up with the rule of 40. It says, as long as the revenue growth plus operating margin is higher than 40, yeah, I think we'll give you some credence. It means if I'm operating margins are negative 20% or negative 30%, as long as your revenue is growing by 70%, fine. What I don't want to see is revenue growing at 10% and operating margins are negative 50%. And believe me, there are companies that I've seen. And it is possible, maybe for 1 year, 2 year, 3 year, but I see this as a trend. Then you start to question, can they ever, is there something broken with the business? How long do you want me to wait? You're growing your revenue and your margin continuously. Basically you're spending money to just buy the revenue kind of stuff. Right? So then I don't like those companies. Right? This is where my patience will run thin. And then I'll say, okay, what? Not really worth it. But if you are sacrificing margin, then I need to see the growth in the company. And this rule of 40 will tell you, I think the street considers 40. You might come up with your own number. Are you okay with 30 or you want to be a little more stringent and want to go 50? It's entirely up to you. Okay. Be careful because this is not a gap metric or anything like that, right? That's how street wants to look at. Now on top of it, some of the CEOs will bring in adjusted stuff, adjusted operating margin, right? They'll say revenue growth plus adjusted operating margin. Then you have muddied the water. Right? We already gave you a little bit leeway for you not making any money because you're growing, but then on top of it, you're gonna come and say, I'm gonna adjust this for this expense, adjust this for not include stock-based compensation. I'm gonna adjust this for this one-time expense of restructuring that we have done. Dude, you've been doing restructuring for the last 3 years. It's not a one-time expense, right? So I hate when the CEOs come and talk about rule of 40, but then they say revenue growth plus adjusted free cash flow or plus adjusted operating margins. So my antennas go, okay, I need to figure out why they are doing this. So be careful of that. Other one is EV by gross profit. Right? Now, why you want to look at it? Because not all revenue is created equal. You might still be able to have $10 billion of revenue right, at your EV of, let's say, $100 billion. So that'll give you multiple of 10. But is that, and you could have another $10 billion of revenue, but the profile of the revenue could be very different, right? So let's say SaaS companies versus non-SaaS companies, or within the software companies, you have a purely SaaS companies which have a huge gross margins, 80% plus, and there were companies like Palantir, which has got a heavy implementation cost, what they call as the forward deploy engineers, right? FDEs. Or during my corporate world, we used to call it as a professional services consultants, tech consultants, who will sit with a client and work out the requirements and implement for it. Clients love it, but then it erodes the margins, right? A higher gross margin would indicate that this company has a little bit of moat, or it is a capital light business. And I may want to pay a little higher multiple for that. So in that case, if you are valuing businesses, two different businesses, based on how they're how capital heavy or light, this metric will help you. Because not, like I said, not all revenue is created equal. If you're having a revenue of $10 billion with a gross margin of 50, I would not want to give the same multiple that I'll give it to $10 billion with gross margin of 85. So when people talk about Palantir is growing at crazy numbers, sure. But look at the look at the gross margin, right? I don't consider it as a pure play software company. So, and that's why I have my own concerns around Palantir, right? It's a gross margins are, oh, come on, where's the gross margin? Palantir, okay, they are probably not including the PS cost then. You have to dig deeper into where they include their PS cost. Right, look at operating margin of 10%, 5%. Probably they're including the FD cost in these ones, 10% in operating margin here. Whereas look at the software company, I'll pick Microsoft. Look at their operating margins, 46%, 41%. And Palantir can't even meet that. So that's why I'm a little more concerned about Palantir. Great stock, been a good winner, but it's because of momentum, not because of the quality of business is that great. Right? I agreed, revenue is growing, but at some point of a time, can you convert the revenue to little higher margins? It seems to be a little tough with Palantir. Right? Any other company want to look at? I think AAOI, I don't know where that is, but Rajiv brought that up. 80% revenue growth. This is because I think the recent tailwind, 14%, 9%, 22%. It's been all over the place. What is this? Negative 30, negative 28.
Right. So you have to consider that the realization that optical is going to be needed badly compared to copper only started maybe 9 months ago or
Yeah,
6 months.
last year.
Oh yeah, in fairness, you should look at the quarterly data for this as opposed to yearly, and also compare with light and
Right.
CNR.
So great revenue growth, but some part of a time, they have to figure out how to make money out of this.
Yeah, they'll never get there because on the experience we had in year 2000, they will crash and burn soon.
Yeah. So then I would not want to back up the truck on this company. Business is not great. Right now it's running the momentum of huge revenue growth, and which is fine, but eventually zero operating margin means you are just paying up. You're giving $100 to buy $90 of revenue. Let me put it that way. You're spending $100 to generate revenue of $90. Would you ever like run your household like this? No, right? That you're gonna go for you got a job, you're paying your company $100 so that they can give you $95 worth of salary. Never do it. Right? But then you can claim that, hey, I'm getting salary hike every year. I get a salary hike of 20%. And maybe if you're in the market, if you're a prospective groom or a bridegroom, the other party might think, wow, you're growing your salary by 20% without realizing it that you're paying the company. So what come take home is nothing, right? So again, I would not want to back up the truck on this one because this is driven by, you can run the charts on, you can trade charts with this, trade it based on the charts, but not long-term position. It's not a great business over the years. And not to mention, they've been diluting like hell, right? That also to look at. Anyway, going back to the margin side, right? So that's where you, we were talking gross margins. Not all revenue is created equal. Why did MSFT drop so much, and what are we missing? MSFT right now, it's a good business. Right now, the concern of the Microsoft is OpenAI is going through some challenges. Remember, there was a podcast with Brad Gerstner, Sam Altman, where Sam Altman say, if you want to, Brad Gerstner asked, right, you're made a commitment of whatever, $1 trillion worth of a commitment. How are you going to make, money? How are you going to sponsor? Then he told, if you want to sell your shares, I'll be happy to buy it. That should have been a signal that when the CEOs talk in such an irresponsible manner, being cocky, maybe top or maybe getting closer to it. What I heard on, or what I've been reading nowadays is OpenAI is having tough time in basically raising capital because the big money managers are getting more attracted towards Anthropic. There was a news around OpenAI is telling their investors that you could get 17.5% return, kind of a guaranteed. Right? Why you have to go and tell your investors if there is so much demand of your shares? That's not the case. And now, because Microsoft has a big dependency, it's not as big as what market thought earlier, but still, revenue numbers or the projections in Microsoft, OpenAI is a big part of it. And Microsoft is also a big shareholder in OpenAI. I think that's a concern which is driving Microsoft down. And not to mention the overhang of all these hyperscalers spending billions, hundreds of billions of dollars, $700 billion this year on CapEx. And the market is questioning, will you ever make money? Right. Gone are the days, 2025, or let me say early part of 2025, 2024, you come and make an announcement that I'm going to spend $50 billion in CapEx, market say, go ahead, right? You have to spend to make money through AI. And over the year, market is like, will we ever make money? And now if you come and tell them I'm going to spend $100 or $100 billion, the market is like, come on. We don't see how you're going to recover it and it'll punish your stuff. That's the stuff. That's what ailing Microsoft. Now the question around, you look at all these metrics, obviously, okay, tell me, is this company undervalued or overvalued? I don't think there's a right number to it. Well, investing is all about trade-offs. What other opportunities do you have? Is there one absolute number that is right? Probably not. If that was the case, I would not have been able to invest in some of the, good winners. So when it comes to the numbers, I've been a little more nimble. Looked at what else is happening in the market, what's the condition with the liquidity or the rest of the market is feeling, and then, maybe 23 times, 25 times the PE or EV to revenue is not super expensive if I have a 0% interest rates in the market. But it could be a very expensive one if the interest rates in the market are way higher, right? So, and also I look at, hey, where the other stuff is trading. So Jamin Ball does a great job every week or telling you where these SaaS companies are trading, right? So all these, I think many of these metrics I picked from Jamin Ball, then I added a few others. So top 10 EV to next 12-month revenue multiple. Palantir trading at 48 times the revenue multiple. Top 10 average is 15.7. Okay. Median is 9.8. Top 10 median. Overall 3.2. So overall, and again, now if you don't look at it in isolation, if you go back, I can look at how the multiples have changed over the years. Look at this. This is the median. The one which you see in blue. Look at 2021. We were trading like 20 times this. Median was trading at 20 times sales. There were companies that were trading at 80 times sales. Snowflake was one of the company. 80 times sales. And again, Warren Buffett invested in Berkshire Hathaway invested in Snowflake pre-IPO, and people are going crazy. If guys, you are a value investor, you are a student of Warren Buffett, why are you not buying Snowflake? I can't buy it at 80 times sales, guys. Like, they will need they will have to sell more than the overall TAM that they indicated in their S1 to make any justification to that multiple, right? And now this is a median. Now the median has come down to 3.2x. It is cheaper than where it has been for the last 10 years. Right? So you could think, wow, that's great. We should go and buy all these companies because these multiples are so cheap. That's why we bring in growth into picture. Look at the growth expectations have come down. The growth expectations have come down. That is why the multiples have come down. There is a reason behind why market doesn't want to give that much. And now market could be wrong. If you think that these companies are not going to grow, or the market has basically considered to be almost a dead company, these all SaaS companies will be taken over by cloud plugins, and you think that's a mispricing, yes, then 3.2 multiples of EV to revenue, next 12-month revenue, is damn cheap. Never had it in last 10 years. This is a 10-year worth of data. But if you think that this is gonna get disrupted, then this is justified. That's why you need to bring in your own thesis around how you understand these companies or this sector. No analyst can tell you. Right? It's about what do you think is going to happen in future, or what do you feel comfortable with it. Right? EV to NTM to next 12 months growth. Yeah, like we're looking at fairly less growth. FCF multiple, free cash flow multiples. Due to next 12-month free cash flow multiple is also even from a FCF perspective, it's pretty cheap. Yeah, these are some of the valuation metrics that you could look at when evaluating some of these SaaS companies. Questions? Useful? I know this is like some people just tell me the stock and the price that I want to buy. Don't bore me with these things. But if you really want to, I don't want to give you fish. I want to at least Discord teach you how you should fish yourself. Don't be 100% dependent on Barron's or any Wall Street analyst to tell you, or Bloomberg to tell you this is a good company. You have to use your own judgment. And now with all these tools, getting all this information will become much easier, right? You ask Claude or Chat GPTs or Gemini, whatever, or if you have a subscription to some other website, this information is already there. And Wall Street could have a different incentive of why they want to tell you that this company is great. You never know what those incentives are. Remember, not too long ago, my favorite example, Wall Street wanted to sell you WeWork at $47 billion. It's a great investment, buy it. When you turned around and say, can you buy it at $8 billion? They said, nope, we're not going to buy it. You buy at 47. I'm not going to buy it at $8 billion. So you gotta look out for yourself. All right, let's get on to no further questions. So let's get on to SpaceX. Okay, so these are the operational metrics we looked at last week. SpaceX. We don't even know what the ticker would be. So there are a few tickers that I think LLMs are assuming. How many interested are in SpaceX? Raise your hand. One. That's it. Come on, this is the James is like not for IPO. Yeah, Jenny says yes, Asif says
I'm
yes.
skeptical.
Elias, you have a question? Go ahead and ask. Elias, you already your hand up. Okay. The question. Okay. Can you trade on this as a retail investor? Elon Musk has been very generous. So we'll talk about it. But SpaceX has generated so much interest in the market. And again, I think from a bigger market perspective, I want this to be successful, right? Because if this is successful, there are a lot of companies that could sense that there may be an appetite. And, this will basically reinvigorate the whole IPO market, which kind of I mean, we saw some companies coming and then in later part of 2025, it became, cold turkey again. But 1.5 to 1.75 trillion dollars is the expected valuation. Oof, you're paying a lot more for future growth. Uh, only, so I say, can you trade on a retail investor? I think the allocation to retail investor, generally, the companies will allocate 5% for retail investors. That's where, as a retail investor, you can tell your brokerage firm, I want to invest in. You can say, give me 100 shares, you'll get 2 shares, 5 shares, 10 shares, whatever. Here, SpaceX, the allocation is going to be 30%. 30 is what the currently is, that they say they're going to allocate 30% to retail investors. Elon loves you to make rich. Okay, that was a little joke, but the reason why it's 30% is, number one, with the experience of Tesla, Elon knows that he's got a huge fan following in retail investors. It doesn't matter. They're going to hold the shares. They're going to play with it. They're not going to sell the shares because it's Elon. At the end of the day, it's Elon. I think the bigger stuff is based on whatever happened over the last few years, where his pay package of like $400 billion, whatever was contested in court, and now worthy of maybe $1 trillion pay package. If you have 30% base as retail investors, we're all going to vote what Elon wants us to vote. Institutional shareholders will do their own due diligence. Elon says, or the board of directors, which is anyway Elon's chummies, they're all buddies. If they say, okay, on all these proposals, please vote yes. You and I are not going to go against Elon. Come on. We'll just go and vote yes. Right? So I think I think that's one another bigger reason why he wants to give a little more allocation, because he's got a herd of people, right, who just gonna go and do what Elon tells them to do. At least that's what the experience on the Tesla has told him. So he wants to give allocation of 30% to retail investor. Now, as a retail investor, you have to think how you want to buy. Right? All great fundamental investors missed out Tesla's, making money in Tesla. But all great fundamental investors also missed out on losing money on Tesla in last 4 or 5 years, where Tesla has done nothing. It depends on what stage of the company you are. Initially, it's all about the stories and the narratives, and later on, it starts to become about the numbers. Right now, SpaceX is all about stories. Numbers, there's nothing much to show for. Right? If you look at SpaceX, and I have some numbers out here, is it's got 3 companies underneath it. Not 3 companies, but the line of basically it's also has the 3 companies underneath it. It's got Twitter, because Twitter is losing money like hell. Not losing money, or let me put it that way. When Twitter was bought in 2022, the amount of revenue that it used to generate, now the revenue is very less. Again, it's not a public company, but hearsay is that they are not generating as much revenue as they used to generate in 2022. Right? For all the reasons that companies have concerns with Elon and whatnot, and how the way he has changed X. So to keep X alive, he merged into SpaceX. And the second thing is same with the case with XAI, which needs billions and hundreds of billions dollars of investment. to build terafabs and data centers. And if you really want to compete against Claudes and the Chat GPTs and Geminis of the world, where that money is going to come from? I'm going to get SpaceX private from private to public. Let's put in all this. It was a very tough negotiation to get this in because both sides were Elon. Right? Who's going to question anything anyway? The Elon who owns SpaceX is going to fight tooth and nail for the shareholder of SpaceX to bring in the assets which are losing money. Sure. Not the first time, won't be the last time. We had a similar deal with SolarCity. Both parties were Elon and Elon brother, whatnot. But same is the case. So now, along with the SpaceX, you're also getting a social media company and also getting an AI company, right? Maybe there is a synergy to it. That's what Elon will explain. And if you buy into that logic, great. I'm not saying right or wrong. I'm just putting the facts together and you have to buy into the story. Because there's numbers, there's nothing to look at. Right now, it's only how much you believe in the story or what Elon is telling you. Now, within SpaceX, forget about the XAI stuff. Within SpaceX, these are the pillars which they are saying. We got a Starlink, which is a cash engine, which generates cash. Then we got a Starship and launch monopoly, right? So they have deals with Pentagon and they have deals with the government in terms of, and all the tailwind around creating a space force, expedition to Mars and all that stuff. SpaceX is the leader. There are other companies like Rocket Lab, etc., also in similar business of launching private rockets for government agencies. But SpaceX is the biggest player, kind of a monopoly so far, right? And then the Starlink is for giving internet access. Now, having competition with Amazon Project Keeper. Third one is a synergy with AI. Because they're saying SpaceX, we're gonna build data centers in space, right, to run all the AI stuff. So basically, the XAI's data center will be run by SpaceX, and that's why they merged it. That's the logic that hey, we merged it because who's gonna, to build the data centers in space, we need these rockets, right? So that's basically three level from a business perspective. Yeah, Rose, you have a question? Go ahead. You had a hand up. All right. Maybe no question. From a numbers perspective, right, these are the numbers. Total revenue right now is $16 billion. Forget the breakup. Right now, total revenue is $16 billion. And projected revenue is $23 billion. So now you run the numbers. What are you paying up? How much of the growth is being baked into this valuation? You're looking at $1.5 trillion. That is gazillion multiple of your 2025, right? And little less gazillion multiple of your 2026 forecast. Maybe this company will continue to grow. So from $16 billion to $24 billion, that's like 50% growth. Right? For a 50% growth, maybe it'll continue to grow 50%, 100%, right? But not many companies can continue to grow at the pace of 100% growth years after years. We don't have many such companies. Maybe OpenAI was the first one. Maybe we'll have some of these cloud companies, AI companies. That's going to be maybe 1 year, 2 year, 3 years. Growth is going to taper down. You have to figure out how much you want to pay up for these revenue growths, right? Yeah, 80 times sales or 63 times forward revenue. What from a capital allocation IPO mechanics, 30% IPO will be reserved for retail investors. Right? So great. You have at least 6 times more chance that if you tell your Fidelity or shop folks that I want to invest in SpaceX, You have 6 times more chance of getting the shares as compared to some of the previous IPOs, right? But in secondary market, the shares were sold at $800 billion valuation. What happened since December to now? Right? So now suddenly we're looking at potentially $1.5 billion, almost double that valuation. Has the business really become so? Has the business really changed so much in 6 months? Or the future projections of the business has changed in 6 months that you would be willing to pay twice that amount, which the insiders sold at 800 billion? I don't know. It's all about stories right now, guys. Numbers just doesn't justify anything here.
So looks like the investors are cashing out.
Yeah.
Definitely, they want to take their profits and let the company grow on the public money. That definitely seems like the case here.
Yeah, and that to let suckers come in and buy it at 1.7, whatever, 60 times the revenue multiple. Let retail investor come in.
Yep.
Right. So again, these risks, valuation is so high. We have a key man risk with dual structure. This is the bundle risk, right? That you got a Twitter inside it. Now, I don't know how is Twitter going to help SpaceX to launch rockets. Maybe it would. I can understand maybe a little bit of an XAI, but the social media company, I don't know, that could be a drag on it. In my opinion, it's purely a speculative play. Nothing wrong in that. You want to take a gamble? Sure. You're putting on a Russian roulette? Sure. Just don't put your house money, put your mortgage money on Russian roulette. Right? Put your play money in it. Now, if you think that Wall Street wants to help retail investors, you're wrong. 21 banks are officially involved in it with some lead writers. Morgan Stanley, Goldman Sachs, JP Morgan, Bank of America, Citigroup. All of them are involved in it because there's a huge amount of fee to be made. Guys, you're talking about if it goes in $1.5 trillion, someone from investment banking can tell me what's the percent fee. How much banks charge? 1%, 2%? Can we ask Google? Normal, what's the industry standard fee for investment banking service for IPO? Wow, 4%. And if we can get it to IPOs at $1 trillion, which is like lower than the lower range, you're gonna make tons of money. So they don't care whether from their perspective, they would want to push the valuation to $5 trillion because they're gonna make a lot more money, right? So discount anything that these banks put out. I've seen all of these banks push out all the crappy companies because they're gonna make you fee on it, right? And then they're supporting banks anyway. And some of the banks have a conflict of interest. For example, Morgan Stanley. Morgan Stanley is basically on almost Musk All Ventures. And remember, Morgan Stanley was also the lead banker in the when Musk bought Twitter in 2022, right? There was a lead portion of the $13 billion debt was Morgan Stanley had $3.5 billion. And that is right now underwater. Or maybe not underwater. Maybe I think at the end of 2024, they were started trading at par. So anyway, so that's been a pretty bad business deal with many of these bankers. And that they still wanted to maintain relationship with Elon Musk. So, they didn't sell off those bonds, etc., because they want to be in good books of Elon for this moment. Because they knew SpaceX, etc., will go IPO sometimes, and that will be a big IPO, and everyone wanted basically their fingers in the pie. They manage much personal wealth. Right? Bank of America also has a original Twitter debt on their balance sheet. Goldman Sachs is little less exposed on Twitter balance sheet, but they provide margin loans to Elon Musk because Elon Musk will pledge Tesla shares, and then they'll basically give a margin loans to Elon. So at the end of the day, all of them have some exposure. So when the analysts of these banks come out and tell me that all this Glass-Steagall, like there is no relationship between the research and the investment banking department, sure, I don't buy it. So when you read the research reports from these banks, tell you how great the SpaceX is, understand that they may have this conflict of interest. They want SpaceX to be valued at highest price. That will make Elon happy. They are not looking for your happiness. Everyone is looking out for themselves. You better look out for yourself. Okay. So I'll ignore this. Yeah, I guess so. Yeah. So if you really want to read the research reports, read maybe some of the ones that are not involved in the syndicate. Bernstein. Maybe they will provide little more unbiased reports. All the other banks could be heavily biased because their business will hurt if investors don't buy SpaceX at this particular valuation. Plain and simple. And like Charlie Munger says, look at the incentives. It will determine their actions. If the incentive is to grow my business, which every bank would want to, their incentive will be to bid up the price of SpaceX as high as they can. Not that SpaceX actually deserve it, but because they're gonna make tons of money from a long-term perspective, building a relationship with Elon. So you be careful. On top of it, I didn't have it here, but since someone brought up the NASDAQ, top of it, the exchanges are bending their back and bending the rules of how much, the criteria on which these gets included in the index. So NASDAQ, and we covered this in one of our previous meetings, generally give some time for a price discovery, right? So that if the company is public for a few months or a year, you know what the right pricing to pay, right? Rather than taking the bankers, the words on face value. So there's a price discovery that happens. You need to have, okay, minimum you should have this much float, and then they'll apply a multiple of float and then include with that weightage in the index, right? NASDAQ has thrown all those rules out just to please Elon. So it is possible that this might get into some of your, whether you like it or not, at the higher valuation might get into your retirement accounts because QQQ is gonna buy it. Then you need to decide what you want to do with QQQ. But at least understand that Wall Street is changing the rules for SpaceX because it's such a big money spinner for them. And any exchange, the exchange make money through exchange fees, right? And then they also do some other stuff, which, if you are listed there, I don't know how all they make money. But so every exchange would want SpaceX to be listed on their exchange. They don't care about those who are buying those index funds. Yeah, we'll bend the rules. Okay. All right, so that talks about SpaceX IPO. Even if we get an IPO document, S1 document is available for public. Right now, they've only filed private. So it's not available for public. Some market commentators say that maybe around May timeframe, that S1 may be revealed and be open for public. I don't know what else can we do from that document anyway, right? It's a straight business. It's all about the narratives, which we're already aware of. It's all about Elon and new narrative and the stories from Elon. Cool, that's it. So right around 12:15-ish. Thank you for your patience while we went through these for our today's agenda. I'll open it up for have some free form discussions. I'll open the breakout rooms.